Hello, it is Wednesday, February 10th, 2021, and I am just going to give a little bit of an update on what I see in the markets here coming into this week and longer term. So let's start out with the SPY. You're looking here at a SPY chart, a daily SPY chart going back, well, to 2008, 2009. And we have this trend line that's been coming up since then. It has a bunch of reactions. And what we see here is that in 2020, when we moved above that trend line, the market broke down. And here you can see when we went up against that level, let me move this out of the way, the market had a false breakdown, recovered, and we've actually been able to move above this longer trend line successfully, at least so far. What I think is important to note, though, is that we have at least coming up the last few days making all-time new highs. They've been very small moves up in the market, which isn't too surprising. Most of this little grind up has been small moves up, and I guess that makes sense. The market sort of stabilizes and becomes less and less volatile until it doesn't, and then it has bigger moves up and down. So that's not too much of a surprise. What is interesting, though, is that the volume, at least Monday and Tuesday, was very, very low. I think it was basically holiday volume, or the only other days that had lower volume in the past few months were holidays, or November 27th, which, yeah, that was a holiday week. So very low volume. And we've got negative divergence that still appears to be intact. Today we've had a little bit of a bigger move up, but then a kind of a correction. And let's go to the 15-minute chart. You can see we were basically strongly rejected after moving just a little bit up. And I think that may be bearish, because we tried to pop above this this level, this purple line, which I guess represents the trend since really October. We popped above it, and then we were swiftly rejected and thrown back down. And we ended the day in sort of the middle of the range, a little bit below previous days. And so we may see a correction. Now, it'll be interesting to see if we're range bound between these two levels. That might be pretty bullish, because we may make a couple more attempts to break above this level, and we may finally break above, and that may be a final sort of market blow off top. Another something, well, another possibility is that we continue in this downtrend, or basically get rejected. There's a sort of lower, maybe something like this would be the lower trend line. I know I erased all my markup for the chart, basically to start over at the beginning of the week. And but the second scenario is that we're rejected, we come down to this trend, the bottom of this trend channel, and it's business as usual. It's just a small move down, and we continue range bound. I think more likely, though, is if we do break below this line, is that we continue to see a bigger move down. And that's just because this is a much more significant trend line than this purple line here. Another thing to point out, though, that this may not be the top, or another reason I think this may not be the top, is if you go looking at the gold chart, most of the market has had a nice move up recently, except for the precious metals. Gold really hasn't participated in the big rally since August, or in the market rally or mania since August. Silver has tried to participate, but uh, it's gotten strongly rejected. So I'm wondering if there's going to be a big rally in gold and silver before we see a market top. And part of the reason behind that, why I don't think we're just going to get, why we're not going to break down in the precious metals is one, I think okay, so you're not starting to get negative or bullish divergence in gold, but what you do see is that we've made another low. We've been in this downtrend and we've sort of started to move sideways, but this most recent low has not been a lower low. Originally, I was thinking if we make a lowest low, it's probably going to be somewhere between this level or this trend, lower trend line, this level, because this is strong support. The 1730 to 1750 level is pretty strong support. And this line is a possible trend line. It's not a confirmed trend line, but it makes sense that it's a trend line because it has a reaction here and a reaction here, and it's parallel to a more confirmed upper trend line of this channel. So my initial reasoning was that we would be likely to be, have our low somewhere around this area, would be a likely low. At this point, if we do break down, then basically I'll have to reevaluate. It's not too uncommon for gold to kind of fake out breakdown after a long consolidation period and then move, take off to the upside. So maybe we, a second scenario is we see a big market correction, gold starts to break down, but then it's not a full market breakdown and gold breaks out. Another thing to note is that we've been spending most of our time between this sort of lower range of this trend channel, the lower half, and then recently we broke out and we've kind of flipped to this higher range of this trend channel, which I think that's bullish because it shows that we, basically on the opposite side of the range that we've been in for a while. You could think of it as a breakout that is just doing a bunch of back tests. Silver has been in the news quite a bit lately for basically it started as the Wall Street Bets group were trying to make a run on silver. They were buying physical silver, they were buying the silver ETFs, and basically trying to put in a short squeeze or create a short squeeze for the silver market. This has not been successful. You can see, I think, a little bit better what happened if we look at the SLV chart. I'm going to move to lines so that it's easier to see. But you can see on the SLV, we have had the single highest volume day in silver since very close to the 2011 highs, which I think this actually might be the 2011 high or the day after. Yeah, a little bit after the 2011 high. So that's notable. The fact that this happened got, basically silver was being bought up, but it got rejected. And that, I think, is a testament to how tight of a grip that the big banks have on silver, the investment banks. Some, for whatever reason, they don't want silver to take off yet. I think at some point they will either allow it to take off or they will lose control and it will take off by, without without them having a say in the matter. And part of the reason is physical silver demand is skyrocketing to a level where most bullion dealers are having a hard time keeping up with orders and sourcing their silver. And that problem is running into the, well, it goes all the way up to the 1,000 ounce silver. The trouble that's with sourcing the silver. So silver is being bought up like never before, but the price is not moving. And I think it has to at some point. So that's another reason why I wonder if silver will take off before we have any sort of market crash. I would be surprised to see silver move down very much in a market crash, although I suppose it's possible. A lot of people would have to be dumping their silver though. And I think it's less likely that that happens when the trend is so strongly up in the demand for silver. It's really hard to see how demand for silver is changing by just looking at the charts though. I mean, you would think here, like, we're basically just above 2013 demand levels of silver when silver was fading. Silver on the year we're basically up, or sorry, I guess since before this whole pandemic thing, we're up about 50% on silver, which is no small amount, but there's a lot of assets that are way up. And that's what I want to go through here as well. And I think this is a good transition to go into some of the assets. But before I do that, I want to show another interesting thing about gold and silver, and that is the comparison of gold to the 30-year Treasury bond. And I'm sure most people have heard before that have been following gold and silver that the gold is it's heavily correlated with, I guess, the price of the 30-year Treasury bond. I'm not sure if it's the 30-year Treasury bond, but one of the Treasury bonds it's pretty highly correlated with. And you can see here some of that correlation does exist between gold and the 30-year Treasury bond. All I did was I scaled up the TLT chart to sort of match the price of gold here and the price of gold here in October. And you can see there's a pretty strong correlation, at least with the price action direction. So that means as the price of gold goes up, the price of the TLT goes up. And, pretty tightly they're linked. They move up and down together. Maybe there's a couple days lag between one and the other, but it's not too bad of a correlation. So I guess that brings the chicken and the egg problem. Why has gold price been going down so for all this time? Why has it been consolidating for so long? So let's just look at the bar chart of the TLT. And the reason I'm using TLT, I'll look at the TLT briefly and then look at the 10-year Treasury and the 30-year Treasury. But this is the TLT chart that, I guess that's the 20-year Treasury, sorry. When I said 30-year Treasury on the other chart, it was the TLT, which is the 20-year Treasury bond. But anyways, we've been in a downtrend on the TLT, and what's interesting to note here is that we are starting to put in bullish divergence, which is something you don't see in the gold chart yet. I'm going to flip over the GDXJ before I forget and show that there is some, is it in the, I think it's very slightly in the GDXGA that you have bullish divergence. So yeah, we have a low here, and then it's very hard to see, but a slightly low here, and we're starting to turn up on that. I think it's a little more obvious on the GDX. Yeah, it's a lot more obvious on the GDX that we've, well, barely have a lower low. No, it's not even, you can't say that's negative or positive divergence, bullish divergence here, but it's pretty close. Some of the miners, it's for sure there. If you look at Barrick Gold, you absolutely have some unquestionable bullish divergence. So it's showing up on the, some of the miners, it's showing up on the TLT. Now what does that mean if the TLT is starting to bottom out? That means, let me go to the 20-year. The price of the 20-year is inverse to the interest rate. So that means we're likely to see a reversal in interest rates, meaning that they're going to be turning down, if that is truly the case, if there really is going to be a reversal soon. Now looking at the 20-year bond, this does look almost like a rising wedge with a sort of blow off top. So I wonder if that's going to be what we see soon, is the 10-year bond breaking down. Why would the 10-year bond break down? The US Federal Reserve doesn't want really interest rates to go down unless, one, they want inflation to increase. Why would they want inflation to increase? Maybe they want, maybe something happens that causes a panic in the market, and they feel like they need to inject, I guess, liquidity into the market. That's what I would think. Or people are fleeing to treasury bonds, and it's not the Federal Reserve buying up the bonds trying to drive the interest rates down, it's the market itself fleeing to treasury bonds, and that could coincide with a market crash. So I'm not an expert on this, I'm not sure it's going to work that way, but some things to think about. Let's look at the DXY quickly. And you can see the DXY. We had a breakout in the dollar. And I expected it to move all the way up here to this 92 level before turning down again. So the fact that it got rejected here, really that's not, I don't see a clear, okay, so maybe there is back here a level of resistance where on a technical level you can say it got rejected from, so I guess, this bottom or this level in 2017. I'm curious to see whether this dollar is going to bounce off this area and continue another move up, because this dollar, let's see, did this coincide closely with the false breakdown in the SPY? I'm going to check. The breakdown in the SPY started on January 27th. This breakout started, you can argue it started on January 27th. It started to poke through. So we had a false breakdown in the SPY right about the time we broke out in the dollar. And now this is breaking down. So what if we have a false breakout in the market and then this turns around and the market breaks down a little bit? That'll be something else interesting to see. But again, I see a bunch of possibilities that on the one hand tell me that gold can go soaring very soon and silver can go soaring very soon, and on the other hand are saying that the market is trying to break down, or showing warning signs that it may break down. The dollar being here outside of this falling wedge, unless this recovers and continues breaking down, which I think that's likely. If this breaks down into here, then I think it's quite likely that the DXY breaks down below this $88 level area, and we do see a real rally in the gold prices, and the market has a big bull run. That's a likely scenario. But if we don't do that and this turns around and moves up again, it's a little harder to say what's going to happen in the market. I think we're going to see at least a correction. So we're really at still, I think, a point where it's important to be cautious, but I am increasing my allocation to gold and silver stocks, anticipating the breakout, as well as putting some, buying some put protection through the U of EXY. And I think that sort of hedges my portfolio a little bit, and should protect some of the downside if the market does crash, while making sure I don't miss out if gold does have a big rally soon. Okay, so I want to look now at a little bit of a bigger picture on gold, silver, and commodities. Now you can see gold appears to be in sort of the beginning to mid stages of a bull run. We've had this peak back in 2011 and then a move down, and now we're moving up pretty rapidly. And you can see in the 2008 time frame, gold had a big sort of drawdown period right around the market crash, but gold didn't. I don't think you can say gold crashed. I mean, from the top to the bottom, that's a 32% correction. What have we had here? From top to bottom, 32% would be this much. So yeah, that would be a big deal, and that would probably put a lot of pressure on the miners again, but most of them, the good ones, would survive a move down like that. That's well, yeah, if we have a market crash, it could be more of a crash than what we saw in 2008, just because, well, I mean, we've basically been setting ourselves up for the market crash of a century because we've been pumping it and pushing it so hard. So it's hard to say what would happen to gold and silver if that happened. But that aside, I think the chart says we're set up for another big bull run in gold. from sort of the beginning of this run around 2000 to the top, that was around 600%. So if we run that again from calling this, 24 or 2015, beginning of another cycle, up 600% would be, oh, okay. This is why things were so skewed. Okay, let's try this again. Yeah, so 600%, and then 600%. That would put us at around 7,000 to 7,500 gold. Now, another thing that I find interesting, and it wasn't so obvious until I turned the log chart on, was that gold ran up how many percent before it crashed in the 2008 crisis? Almost 300%. We're only up 90% to the peak. So if things play out similarly or more similarly to where somehow we're able to put off a market crash for another year or two, I would be surprised, but and maybe we have another big run up in gold. We could see a bigger correction down the road that wouldn't look as big on the chart. Because right now, even a 30% crash in gold would basically mean this is a false bull market as far as I can tell. Silver, I think silver almost has more upside because, well, from the 70s, okay, yeah, this is where we're at. I mean, silver just hasn't moved as much relative to how it previously has moved, or how gold has previously moved. We're not even at all-time highs yet. And the demand for silver is kind of, there's a couple of scenarios for the demand for gold. One scenario is that people who want to flee the dollar use it as a safe haven asset, sort of a store of value that's easier, more accessible than gold. And there's a few reasons for that. One is it's more easily exchangeable for everyday use. It's a lot easier to carry around a 1 ounce silver coin and trade it for goods and services than it is to trade the equivalent amount of gold. You would, gold being right now 65 times the value of silver. If you want to purchase groceries, something that is 1/65th the weight of an ounce of silver is going to be pretty hard to keep track of and carry around. Doesn't mean it doesn't exist. It's just a little bit, I guess it feels a little less accessible and manipulable than gold or than silver. So the other reason for being bullish on silver is that it is so heavily used as an industrial metal, and no matter what, I think its use is going to only increase going forward unless we have sort of a worldwide meltdown. So in the worldwide meltdown case, people will want silver as a medium of exchange that's an alternative to the dollar, which will probably, the collapse of the dollar will most likely fuel that worldwide meltdown. The other scenario, and if there isn't a total collapse of the dollar, or if we somehow manage to transition smoothly out of the dollar, I think gold or silver will still have a run for that reason, for the fear reason as an investment asset or a store of value. But you also have companies that need silver for industrial uses, the electric cars, the solar revolution. Those two alone will have, create an immense increase in demand for silver. So, right now, as I understand, silver supply has not been keeping up with the demand for a while. Although the silver market is pretty dark in terms of how visible the demand for silver actually is. You have a fairly good idea of how much silver is being produced because the silver miners are mostly publicly traded companies that release their numbers every quarter. The demand or the use of silver is much less well known. We don't know how much physical silver is on the COMEX. We don't know how much physical demand there is by different companies because they don't reveal that information. So it feels like walking through a minefield and just hoping that you won't hit a mine. That's the equivalent of what I see in the silver market right now. And so I think the most likely what's most likely to happen, I think, is that silver will continue to be fairly quiet until one day it just explodes in price. And that could be because, there's a bunch of reasons I already went over. So anyways, I've been rambling a lot on about gold and silver for long enough. I want to also have a little bit of a ramble about the commodities, other commodities. So crude oil, let's see. There's some interesting charts that I'm seeing in some of these commodities, I guess. Crude oil being one of them. So CL1, crude oil. We've been generally falling in oil price since around 2000. Well, I guess 2008 was the peak in oil price. And right now, I mean, we basically bottomed out back here in May. Let me just turn volume off. So back in May, we bottomed out, obviously, with the negative oil prices, April or May. And if we clean up this chart a little bit, there's some overshoot of this chart, but, well, this is just a falling pattern. And if we break out of this chart, then we may be likely to see oil prices making new highs in not too long of a time frame. And the fundamental reason for that would most likely be, well, this whole COVID situation has created a huge oversupply or lack of demand for oil. And so if oil producers start going out of business or shutting down, oil refineries and oil drilling rigs, if they produce less oil and oil consumption picks back up over the next couple of years, well, that's going to create a supply squeeze, and that will create skyrocketing prices. And so the chart here says that maybe, it's not a certainty yet, this I mean, you could say maybe this is a falling wedge pattern, although the March, what happened in March and April kind of might nullify that. But if we do break out of this pattern, then, or this formation, then we're likely to see much higher oil prices. And maybe we see this turn down a little bit and then break out. That's probably more likely, but I think long term the direction for oil prices, at least in the next 5 years, is up. Natural gas. This one is interesting. Let's see, is this, yeah. So there's a couple charts or ways to chart this natural gas chart, but we had a high in natural gas prices in 2005, and since then we've been trending downwards. And by a couple different measures, okay, yeah, this is, for some reason this charts a lot better when it's not on the log scale. So this still conveys the same idea, and that is that the price has been trending down, and you can say this is sort of a falling wedge pattern, and we may be at an area where we're breaking out and natural gas prices are going to increase dramatically. So making an investment or long-term trade in natural gas may be another good play. I'm going to go back and check and see if this chart, okay, so this chart actually looks a lot cleaner without the log scale for whatever reason. And now it looks a lot more like a falling wedge. So we might stay within this pattern or this chart for a while longer, but you see 1, 2, 3, 4, 5, 6 reactions on this upper trend line, but the lower one, 1, 2, 3, 4 reactions. And so it's a pretty clean chart, and I think what happens long term based on the chart, well, is clear. Okay, so looking at wheat futures, is this another one that one interesting thing about all these charts is that they look a lot better on not having a log scale. I would be interested to know why that is. But you can see that wheat sort of bottomed out in 2016. And it's been moving sideways, and it looks like it's transitioning into a bull market phase now, meaning that the cost of wheat could be in an uptrend for a while, for many years. 2008, interestingly enough, right before our collapse, was the peak in wheat prices. Really the peak going off, I guess that was the all-time high. Soybeans. Now, unfortunately, it's pretty late to get on this trade, but this is what soybeans are doing. They basically bottomed out in 2019, and they're up 70% since then. And yeah, according to this chart, they could continue going up for a while longer. If you see this as a bull flag pattern, I wonder what could that mean 200% increase in the price? I don't think this is a bull flag so much as it's just a falling wedge, but it looks like a bull flag. It could be 200% increase in soybean prices could be on the table from from the bottom of the wedge breakout area. Corn futures. This chart's very messy, and it's not clear what exactly is going on here, other than that no matter how you chart it, we have had a breakout. We're up 90% since the lows here. The low, which was in April 2020. So I think we're likely, being up this much in this short of a time frame, I think we're likely to go much higher. You can see the all-time high was in 2012. We have another 60% to move to get there. But we may be overheated. We may see a pullback and then a move higher, or consolidation and then a move higher. Now rice is interesting. I think that rice is probably more of a signal of what's going on in Asia than what's going on in the Western countries. But it's got the same general pattern where we had, and what's interesting here is we've had, like, the peak in the rice price was really high. From the low to the high here, that was, well, only 150% up. But we had this interesting peak here in May to June of last year. But I guess the idea is we've broken out of trend and we're probably likely to move much higher in rice. We've broken out of this falling wedge or bull flag pattern, whichever way you look at it. Cotton. Okay, this chart looks weird, but the same idea is present here. Where, does this extend all the way out? Not really. Okay, so we've gotten this downward sort of consolidation over many years, since 2010 or so. I'm not sure why this spiked so much. There was probably some cotton shortage. But now we're breaking, since November, October, we've had a clear breakout and we're up 27% in the cotton price. Rubber. The rubber price, there's a couple different ways to look at it. One is looking at a shorter term chart. In that chart, we broke out of this falling wedge back in 2016. Another way to look at this chart is using the peaks of the price. And you can see we've had a third peak back here. So if we break above this chart, then we are probably still bullish on rubber, and they are likely to move much higher, or the rubber price is likely to move much higher. And interestingly, well, yeah, from the bottom to the top, we've moved about 100%, and that was in the last year alone. If we reach the, I guess, 2011 peak, that would be about 115%. And another thing to note with all these commodities is that the price peak was either in 2008 or 2011. So for rubber, we had an initial peak in 2008 and then the next peak in 2011. And that could speak partly to what happens in a crisis, a monetary type financial crisis, is that you suddenly have a deleveraging, which puts a lot of companies out of business and reduces demand significantly. And then later on, a couple of years later, you have a big supply squeeze. Copper is interesting. And what I've noticed about the metals, which you'll see in a bit here, is that rather than a solid sort of falling wedge pattern, these tend to be like horizontal funnel patterns. The long-term trend of the copper price is up. And 2008, we sort of had an initial peak just before the crash, and then copper prices crashed. Then they rebounded to an all-time high in 2011. And then they've been moving back and forth within this formation until this most recent crash where you broke down below, and now we broke out. And so this, well, I would call this sort of pattern the most powerful pattern, because when you see this volatility squeeze, you generally see big moves afterwards. So 250%, if we moved up from the breakout area, would put us just below $10 copper. So maybe we see $10 copper in the next couple of years. That's almost akin to, it's probably not as much as the gold and silver prices are expected to move, but it's not an insignificant amount either. That's a tremendous move if we see copper peaking out. So any miners that mine copper are likely to benefit pretty heavily from this move. Let's see. Steel. Steel is interesting in that we've been in a falling, sort of a falling pattern for, I guess, since 2007. You can see 2008 was the peak, then we bottomed out, and then steel has been moving down steadily. And now this is an ETF, so there may be some decay. The movement may be more of a flat movement in the actual steel futures. But you can see we've had a breakout here. What's interesting is anytime we've broken down previously, it's been a breakdown, but we haven't broken out of this pattern until 2016. Then we broke back into the pattern, and then we've broken out. So we're probably going to see steel prices move up quite a bit in the next few years. Now, to look at coal, I'm using Coal India because it's well, I think it's the best chart I could find on TradingView. Now, let's see. Well, basically, yeah, this isn't a great chart. I'm going to look for a different chart. Okay, so here we go. Not the best chart, but this is what we have. So coal price, well, this is only since 2010. Actually, you know what? Here's what I did. This was my mistake. Okay, so is that right? I'm a little confused about this. I guess what you have here is that coal has been downtrending for a while and it's recently broken down, so it's near all-time lows. At least I think the coal price is harder to get accurately, or to get a good idea of a representation of the entire coal industry. And the reason is there's just so many different types of coal and sources of coal. Okay, so the general trend has been down in coal. I think it's kind of a hated resource right now. It's down 65% from kind of the highs on this chart, at least. This only goes back to 2011. But it's something to consider. Okay. So I'm using this as a proxy for aluminum because it is a company that has been around for a while. And you can see the aluminum price, I mean, basically is squeezing. If you look at this long-term chart of the aluminum price, you can see it peaked in 2008 and it looks like a sort of funnel consolidation really since September 2001. Moving on to zinc. All right. We're going to have to use this other chart for a lot of these. So zinc price, same story, I think. We've had sort of a consolidation. Now zinc peaked in 2006 and then kind of peaked again in 2011, but it's maybe a little bit more volatile. But you can see how it's consolidating just like everything else so far. Nickel. Looks a lot like zinc. Actually, it looks almost identical to zinc. Well, not quite the same, but you've got this consolidation in the price over time. And I think it's at a point where it's breaking out. Lead. And I'm not going through every metal. I'm just going through sort of the big ones, at least the ones I think are the big ones, without being an expert in this area. Lead is also had a peak in, well, I guess that was 2007 to 2008. It peaked out, crashed, and then it's sort of been consolidating since then. What I find interesting in some of these charts is that the consolidation hasn't shown the same type of crash in the price as you saw back in 08. I don't think any of these charts have shown the same amount of crash. But that does make sense because the March crash only lasted a month or two before we got a recovery. Now the last one is going to be uranium. And this one, most people have probably, I mean, this one has been making a lot of news lately because there's supposedly a big supply squeeze coming. And so being in uranium producers right now is going to be a almost guaranteed returns that are very high. So this is another one where it looks like a sort of either a funnel or some sort of consolidation where you have the highest price here and then the price has been tapering down. Each subsequent peak has been less than the last or lower than the last. And okay, so we have this uranium ETF that actually only goes to 2011. Is there a version? Okay, so I think this is the best we got in terms of uranium ETFs. But you can probably see something here, some sort of consolidation, falling wedge type deal, where we've broken out, and now I think we only see upside in uranium prices. So one thing I find interesting about the prospect of a market-wide crash is it's really not priced in to these or it's not showing up on the charts. For us to have a Great Depression like crash, I mean, basically, what would your target be for the prices? First of all, would it be 2001 levels where copper plummets to levels not seen since 2001, or I guess 2001? Is that the sort of crash you would see? Would you see it just crash to 2008 levels? Now, in the March crash, we broke out a trend here. But then, I mean, that's this type of thing isn't too uncommon, where you see sort of a false breakdown in a consolidation chart, and then it falls or breaks back in, and then breaks to the upside. To see another thing like that, where it turns around and then breaks down to new lower lows, well, that would be new to me, at least. It doesn't mean it can't happen. I know anything can sort of happen in the markets, but the chart's telling me that there's massive upside and not so much downside in these commodities. The macroeconomic picture says that we have mostly upside, and a sort of liquidity type driven crash or a debt crisis driven crash is probably going to only be temporary. It may bring the prices down pretty low for a little bit, but are we even going to see prices as low as back here before, well, I guess back in March? Seeing that sort of thing happen twice in a row in such a short time period, I'm not so sure that's realistic. But anyways, this has been a massively long video, and I hope that somebody out there gets some value out of this. If not, maybe I will in the future. But thank you for watching. I will talk to you later.